A strange thing happens inside great software companies. The income statement looks ugly, while the engine underneath becomes unstoppable. A business can appear to lose money quarter after quarter, yet build one of the safest cash machines in the market. The trick is not an accounting illusion. It is the way subscriptions stack like an income ladder, while costs arrive up front. In our first breakdown, we followed the base and learned why the dollars you keep and expand beat the dollars you just won. In the second, we crowned net revenue retention because expansion turns the base into momentum. Now we step into the cash chamber, where timing rules everything, and a loss today funds compounding tomorrow. Start with one hard fact that almost no one outside the room wants to hear. Software spends a lot of money before it earns it back. You pay to acquire a customer now. You collect the revenue over many months. The more you sell this period, the worse your profit can look right now. That paradox is not a bug. It is the shape of a subscription. Hold that thought, because in a moment we will name the trigger that flips a loss-making SaaS model from drag to lift without changing the product at all. The early aha is that billings and revenue are different worlds. Revenue trickles in on a schedule. Billings can surge in a single day if customers commit to annual contracts. When a customer pays up front, cash hits the bank, even while accounting defers revenue into the future. That deferred line on the balance sheet is not dead weight. It is a promise to recognize revenue later, with no additional selling required. Picture a staircase of contracts laid on top of each other. Every new step is another row of future revenue already funded. The company looks poorer on paper and richer in its ability to self-finance. Shift the lens to payback. Imagine a timer that starts the moment you win a customer. The clock stops when the gross profit from that customer pays back what you spent to acquire them. If that happens in 12 months or less, you have a machine that can recycle cash quickly. If it stretches to 24 months, you need patient capital or a strong reservoir of deferred cash to bridge the gap. Payback is the hinge that explains why two companies with the same growth rate burn different amounts of cash. One can sprint without gasping, the other sprints and trips on invoices. Now look at the income statement with new eyes. Sales and marketing show heavy spend because they pull demand forward. Research and development looks large because the product is a long-lived asset that accounting treats as constant expense. General and administrative grows to support scale. None of these lines capture the quiet power of stacked subscriptions. The money you are scheduled to recognize next quarter is already sitting in deferred revenue if your customers prepaid. The cash conversion is hiding in plain sight. Here is a line worth lifting out. SaaS companies do not just sell access to code, they sell time. They trade upfront effort for long tails of predictable cash flow. When customers pay annually, the company is almost borrowing from the customer at zero interest. When customers expand steadily, the repayment keeps rising without new loan paperwork. Over the next decade, the winners will be the ones that master this time shift better than competitors, not the ones that only maximize headline growth. Bring in the rule that blends speed with discipline. When growth rate plus profit margin clears a combined threshold, the market rewards you with a premium because you have proven you can either keep growing or dial in efficiency without breaking the model. This is not a vanity benchmark. It is a recognition that cash burn today is acceptable if the unit economics and renewal behavior ensure tomorrow's harvest. Companies that hit the mark with strong payback and resilient renewal can fund expansion from operations rather than endless dilution. Consider a practical sequence that plays out inside healthy models. Early on, the company pushes for adoption and signs many smaller customers on annual terms. Upfront cash builds the deferred ladder. As cohorts mature, expansion lifts the base, so each anniversary converts deferred obligations into revenue with higher average contract value than the year before. The company then shifts investment into the highest return acquisition channels because every dollar spent now comes back faster and grows larger during renewal. What looked like reckless burn becomes measured reinvestment with predictable payback. Here is a contrarian insight that can feel uncomfortable. Losing money this quarter can be rational if the lifetime value you are buying is both high and likely. That is why companies obsess over the first moments after activation. Time to value shrinks the distance to first renewal. Product telemetry reveals which early actions predict long retention. Sales comp changes to reward customers who expand. Finance raises flags when deals hurt payback. The whole system aligns around shortening the path between cash out and cash back. Now return to the trigger we promised to name. The flip happens when average payback time drops below the term of your most common contract, while gross margin remains high. At that point, every renewal cohort starts throwing off free cash flow that can fund the next cohorts. You no longer rely on external capital to grow. You are recycling customer-funded growth. That is when a loss-making business begins to print cash without changing its growth rate. The statement still shows expense. The bank account begins to tell a different story. Watch what happens during a downturn. Acquisition slows, and sentiment turns. The companies that engineered short payback and built a tall deferred ladder keep investing because cash from prior billings continues to arrive. Companies that stretch for growth with long payback and fragile renewal slam the brakes and trigger a spiral. Timing is not a detail in subscriptions. Timing is the moat. Carry one final mental model forward from this trilogy. Think of your software business as a reservoir. Rivers of customer cash flow in through billings. A spillway called revenue recognition releases it on a schedule. Engineers in product and success raise the spillway by making renewals obvious and upgrades natural. Finance monitors how quickly the reservoir refills after each marketing draw. When the refill time becomes short, you can irrigate new fields without fear. The landscape becomes green, even if rain slows for a season. If this breakdown sharpened how you see cash and software, tap like, subscribe for more cinematic dissections, and tell me in the comments where your payback sits and how you manage annual billing versus monthly plans. Rewatch the first video to cement the base math and the second to master the retention crown. Then apply those ideas to the cash ladder we walked today. The contract is not just revenue, it is time captured in your favor.